Monday, April 5th. Look, guys, it's week. I'm doing my math right here. Week 3? Maybe it's week 2. Oh, wait a minute. Let's see. 1, 4, 5. Yeah, okay, so we got 2 weeks to go, right? So, well, 3 weeks. This week, and then 2 more for 10 and 11. And then last week's like when our final exam will be some sort of a, problems for you guys to do. And it'll pull from all chapters throughout the semester. Anyway, yeah, so this is pretty much week 3. We got 2 to go after this week. So really, it's almost close to summer, even though I would much rather be in Tigerville with you guys. We're going to do it this way, right? So we're going to get through this. And now, please note, I sent an email out the other day about, I extended Chapter 6 material in Unit 3 assignment and exam until Wednesday at midnight. So get that stuff done. If some of you need back work done, I've been trying to answer emails as I get them. I think I've got everybody situated, but if I have not, if I didn't get it done and respond to you, please send it again. Or if there's something that you want to do from even Chapter 1 or 2, I'll open it up for you, but you got to give me the exact item that you want to do. I'll do 1 or 2 at a time. As you complete them, I'll open up more. I want you guys to be successful, but you've got to get your work done if you want to get what you want out of this course. I'm one of the kind of people where I don't care when it gets done, as long as it does get done, but most of this stuff has deadlines that you've missed. But I'll extend it if you go through the trouble of telling me exactly what it is you want extended. Don't do work. Most of the stuff you can't. But don't do smart books, whatever, if you don't have them extended first, because otherwise you won't get credit. So make sure if there's old work you want done, you get with me ASAP. You're running out of time, and I want everybody to be successful. So Chapter 9 is today. We're going to talk about accounting for receivables. We have discussed this topic before. We're going to go into a lot more depth today, okay? Before we start, though, quick message for the day. This is from a guy named Tucker White. He lives in Pennsylvania. Anybody ever been there? I've been there. I've been to Pittsburgh like twice. Okay, and both times I think I saw the Pirates play the Cubs. I think it was the Cubs both times. I'm a Cubs fan, so that's why I went. And my mother-in-law lives about an hour and 15 minutes from PNC Park, which is where the Pirates play. But anyway, this is from, so this is called An Unshakable House, and it deals with Pennsylvania. So let's listen to it. So here it is. I've spent all my life in Pennsylvania. Almost every breath I've taken has been of Pennsylvania air. The cool breeze that came when the weather was hot was recognizably Pennsylvanian. But don't ask me how I knew. I just did. The place was my home. But now I'm far away. I left Pennsylvania for college, and the air isn't the air I know. Familiar brands aren't as prevalent here. The people act differently, and they mention Philly cheesesteaks as if they are some semi-exotic cuisine. This is not my house. These are not my people. But God has remained the same. No matter the location, no matter the culture, no matter the people, God is steadfast. The Holy Spirit has surrounded me. I know my home is where the Holy One resides, and that's anywhere. Okay? So very good message there from Tucker White. I enjoyed it. Hope you did too. I also enjoyed going through the week 2, question 2 answers, which was like your favorite movies. I saw some good stuff in there. I saw some stuff that I was surprised to see. It was good to see. Some movies that I've not even really seen yet, so it was kind of good. And some of them were older movies too. Anyway, let's discuss receivables. So here I got pulled up the PowerPoint, which is available on Blackboard for both classes. So make sure you, whenever you want to, you can pull it up as well. And you see here, we're going to talk about accounting for receivables. And it didn't there we go. Okay, remember, here's our definition. It's just amounts due from customers when we sell stuff on credit. Now, we're going to talk a little bit today about the difference between a credit card and, well, really a store-issued credit card, like a Lowe's card or maybe a Home Depot card or a Belk card versus a just a regular old Visa, MasterCard, American Express, Discover, okay? But essentially, accounts receivable are amounts due from customers when you buy stuff and you don't pay cash. Okay, you use credit instead, all right? So what you have here, okay, this is out of the book, it's a snippet. But you see here, this is the general ledger. So this is like there's going to be one account on the books called accounts receivable. Okay, it's going to contain many, many numbers added together into one rolled up number. In this case, it's only two numbers, but in a business, it may be several, 20, 30 different customers, 100 different customers, even way more than that. So the general ledger account, we would call this the control account. Okay, this would be the number we report for accounts receivable would be $3,000, but that's made up of more than one thing, okay? And so what you would do to see, well, what makes up the general ledger number or that control number of 3,000, you would go to a schedule of accounts receivable. It's a list of who owes us money. Okay, you'd also probably want to know is how long has it been outstanding? How long is it like a week old? Is it 2 weeks old? Is it a month old? Is it 2 months old? Okay, the rule of thumb here with dealing with receivables is the older the receivable, the less likely you're going to collect it. Okay, again, I think I've discussed this before, but if you don't believe me, loan somebody some money and wait 4 months and then say, hey, dude, where's that money you owe me? You're like, what money? Because they've totally forgot about it. They've moved on, okay, and they don't want to pay it back because they forgot about it, right? So the longer it goes, the less likely you're going to collect it. But anyway, so what you see here, and this over here, this accounts receivable ledger, this is some of the stuff that we kind of skipped in Chapter 7. It's called a subsidiary ledger. It would be like the individual accounts. In other words, instead of just doing one T for accounts receivable, you could do a T for each individual customer, where the one side would be the add side, the debit side would be the positive side, and the credit side would be the negative side. But regardless, these would add up to the $3,000, which is reported as one number on the general ledger. Hopefully you could follow that. It's not an overly hard topic. All I'm saying is this $3,000 is made up of multiple numbers. In this case, it's only two numbers, okay? $3,000. These two, RDA owes us money, and so does Comp Store. Now let's see what we got here. Let me get my little board out. Let's do this as an example. All right. So we got AR for RDA. Okay, and then we got AR. Oh, my handwriting's terrible. Comp Store. Okay, and let's go back to what we had on the first slide. I go previous, right? Okay. So RDA is a $1,000 debit balance, and Comp Store is a $2,000 debit balance. Okay, so here's my board. You see it filled out. Okay, you've got over here. You've got what's this RDA? They owe us $1,000, and over here, Comp Store owes us $2,000. All right. Now we've got on the next slide. We've got some activity. Okay, so the first one, Comp Store bought more stuff. Okay, they bought more stuff. Okay, you see that they've increased the debit to Comp Store of $950. Okay, but then the second one, RDA actually paid us some money. It's a good thing. Hey, we got some money, right? Good. Okay, so RDA, you see, they paid some cash to us. A collection of credit sales, so we need to reduce RDA's amount. Oh, I can't write the numbers right. I wrote down 129 for some reason instead of 720. I wrote down 729. So see 720. It's gonna leave us with what? 280. Okay. Let me see if I can do some quick math here. Oh, I'm almost out of the room. 0. 3, carry the 1. This is high tech stuff. I hope I got that right. If not, my wife will shoot me. Anyway, she's much better at mental math than I am. All right. So look what we got now. All right. Oop. Can I get on the screen? All right, here we go. All right. Over here, okay, the first one, okay, over here. You see the addition to AR. So now Comp Store owes us $29.50. Then over here, you see where RDA actually, you see it's a credit. So now they owe us $280. And so essentially, what you'll see on the next slide is my finger. All right. This is the new amount of accounts receivable, right? If I did that math right, I think that math's right. See my carrying them ones? $32.30, right? So that should be our new balance in, not shoes now, but our new balance in accounts receivable. So let's look at some next slide. Oh man, look at this. Okay. So here you see the subtraction from RDA down to the 280. And you see the addition here. Look at that. Look at that. Perfect math. 3230, right? And over here, but in the control account, you don't get as much detail. Okay, so it's a lot less detailed over here in this control account. So yes, this applies for, this is the addition to Comp Store, but you don't know that. This is a subtraction from RDA. You don't know that. You have to dig into the numbers to see where it's coming from. We don't really do that, but I just wanted to let you know that AR is made up of a lot of small numbers all into one big number that we will deal with, okay? Very good. Now, so here is Home Depot, okay? I've got a Home Depot card. I never use it. They're probably going to close at some point because the Lowe's is much closer than the Home Depot where I'm at, so I just go to Lowe's. I do have a Lowe's card. I do use it. The problem there is I use it, I forget to pay it, and they charge me a fee because I keep forgetting. So instead I use the one I always pay, and I don't get this. And whenever you use a Lowe's card, you get a discount too, but I always mess it up. So I tend to not use my Lowe's card. This is Home Depot, okay? So this is a card. This Home Depot card, if you ever go out and get one, okay, they might even give you one now. It wouldn't be a very big limit, but they would probably give you like a $200 limit or something small like that. But anyway, the Home Depot card is only usable at Home Depot. The Lowe's card is only usable at Lowe's, okay? The Belk card, if you know where Belk is, which is a clothing store, is only usable at Belk, okay? So those type of store credit cards they have their own credit department, okay? That's not external, it's all internal. And so what you see here is if you were to go to Home Depot and buy some lumber, I guess, whatever, grill, refrigerator, whatever you buy from Home Depot, you see that the accounts receivable will be $1,000, okay? So they bought a $1,000 refrigerator. We're not going to worry about taxes. We're not going to worry about that. This nice $1,000, no delivery fee, okay? So here's your $1,000 worth of sales, $1,000 worth of, you got it, accounts receivable, okay? That's the beginning of November, okay? Now what's going on here is it's a late pay. They don't pay it, okay? So they've got 2 months later. So at the end of December 31st, now they're going to get a fee. They're going to charge interest on that credit card. So what you've got going on is you've got the company itself, Home Depot, is dealing with accounts receivable with individual customers, okay? And so the risk that somebody doesn't pay their bills is on Home Depot. But any of the earnings on the credit cards, like interest charges, is also revenue of Home Depot or Lowe's or Belk or whoever, okay? So that's if you're using a store credit card. All right, hopefully that makes sense. The store would get the full amount of the accounts receivable. They also bear the full burden of collection, and if they don't collect it, then they're the ones that are out of money, okay? They have to deal with, third-party agencies to try to get their money, and it gets messy, okay? Now, we all know that we've got these bank credit cards, okay? In other words, like a Visa, American Express, Discover. Let me get myself a little smaller here, at least temporarily. You don't need to see me anyway. Also, debit cards. Now, debit cards are tied to our bank. It's a little more guaranteed. But regardless, whenever you're using something like a credit card, like a Visa, MasterCard, American Express, and also that Discover card, right? They're going to essentially, if I go to Home Depot, okay, like in this previous slide, and buy something for $1,000, okay, but I don't use cash. I don't use my Home Depot card. Instead, I just use a generic Visa card. It's a credit card for anywhere, okay? What's going to happen is the bank or that credit card company is going to pay Home Depot almost $1,000. Not quite. They're going to pay most of it, okay? And the difference there is going to be like a fee, okay? They're going to charge a fee. And it says down here that the seller will pay the fee, and it's usually somewhere between 1% to 5%. Okay, so if it's a 1% fee, I swipe that card for $1,000. Okay, the bank will pay Home Depot $990 at the end of the day, and that 1% will be income for the credit card company, right? That makes sense? Okay. So some of these numbers are going to be kind of big, but usually, in the business world, there'll be a percentage, like 1%, but there'll be a ceiling, okay? So it may be, 1% of the sale, but it cannot exceed like $3, okay? It just depends on how it's set up. That's something that you would negotiate, the Lowe's would negotiate directly with Visa, with MasterCard, or with American Express, okay? And this is why some businesses don't accept credit cards, because, the credit card charges a fee. Every time you swipe a card, there's, money's being lost by that business. So if you walk into you might have walked into some specialty stores, and there'll be a big sign at the thing that says, no credit charges, no swipes under $5, because it's just not worth them for them to swipe that card, because it costs them money every time there's a swipe. And also, there's why some businesses just cash only. They don't want to deal with any of this. Like, you know what? There's an ATM outside. Go get cash. Then we'll deal with you with cash. Some places do that successfully. Some places don't. Anyway, so let's look at this. Now, let's put it in terms of. So this is a 4% fee, right? All right. Let's see if I can make some sense of this. 4% fee. All right. So if we'll go to Lowe's, okay, and we're gonna buy $100. What's up with $100, right? What's with $100? Let's see. A nice ceiling fan, okay. We're gonna go buy a ceiling fan at Lowe's, all right. It's $100, okay. Lowe's card, Visa card. Okay, so if I go to Lowe's and I use my Lowe's card, okay, Lowe's is going to get an AR, accounts receivable, for $100, and they're going to record sales of $100. Okay, we're not going to worry about any discounts right now. Okay, so this would be like a journal entry, right? Now I know it's kind of weird looking, but you guys should be used to this for it by now. We would have a debit to accounts receivable. And we would have a, credit to sales for $100. Okay, cost of that ceiling fan. Now we need to do another entry. I mentioned this earlier. Got to do another entry to move the cost of that sale out of inventory, the cost of goods sold. Let's not worry about that right now. All right. Now, if I use a Visa card though instead, and according to this problem, it's a 4% credit card expense. Okay, so if I swipe that card, the Visa card at Lowe's will not get $100. They're going to get $100 less that 4%. This kind of ties into that discount chapter, right? But it's kind of the other way around. So, but the good thing is they get to skip. Lowe's will get to skip the whole accounts receivable process, as you see here on the screen. All right. So they swipe it. Okay, the credit card company charges Lowe's $4, which is the 4% of the $100. All right, so Lowe's will not get $96. They won't get $100. They're going to get $96. All right, and then you got your credit card expense. This is really just rewriting. I'm just rewriting the screen right now. And then their sales will still be $100. Okay. Now, but let's put them up for a comparison at least. Okay, you do see. What do you see? The sales is still the same. Okay. There's also a reflection in the board. Hopefully you can't see anything. My room's a little dirty. Anyway, you see a reflection. You see the sales are both $100. And you see over here, okay, there is no entry to accounts receivable. Okay, because the bank's going to pay them. So yes, there is an expense. Okay, so they're not going to make the same amount of profit. They're going to make less profit, but they don't have any risk of collection of that receivable. Okay. Now over here, there is a receivable amount. Now they will get that full $100, assuming they collect it. So if this person often says, "Yeah, I'm not paying anybody back," then they're going to be out $100. Okay, so that $4 that they're losing over here can also be kind of equated to the risk, right? Because the risk is being assumed by the credit card company instead of being assumed by the store itself. Okay, and that's why there's charges, because the credit card company is assuming that risk. So there's definitely a trade-off. Okay, sometimes you want it's a matter of, can you tolerate that fee, that charge fee by the credit card company. I don't know if we're going to do installment sales. Hopefully I removed it from the problem. If not, we'll come back and deal with that when we get to it, so we'll skip that. Now, the bulk of this chapter is bad debt expense. Okay, it's going to get a little confusing. There's two ways to do it. One's easy, one's hard. Obviously, we're going to spend the most time on the hard method, which is called the indirect method. Okay, so here, let's do the easy one first. Okay, direct write-off of bad debts. Now, when you deal with these write-offs, what does it say here? The accounting for bad debt records records the loss from an uncollectible accounts receivable when it is determined to be uncollectible. Okay, no attempt is made to predict bad debt expense. Okay, so we won't have any predictions, no estimates. If a debt is bad, we'll write it off. This is the easiest way to do it. Okay, so we got this deadbeat here. Okay, Kent. Okay, he owed us $520. Okay, hey Kent, you owe us his money. He's like, you know what? I'm not paying it. Leave me alone. Don't call me again. Okay, and you're like, well, you might be thinking, well, let's just take him to court. Well, the problem is with all the court fees and lawyer fees, if it's you're going to spend more money taking him to court, so you can say, well, I'm just going to write it off. Okay, I hate that losing this $500, but I'm going to write it off. And so what you see here in this entry, okay, we're putting into an expense account called bad debt expense, and now we're going to be writing off that receivable. Okay, so you see, let's write it. Let me do a little quick T here for Mr. Kent, because we're also going to end up collecting it here, I believe. Okay, so we got AR deadbeat Kent here. So we got Kent. I'll put J Kent. I'll be nice. Okay. So when we start this whole ordeal, this is what's, if you go to his individual account for Mr. Kent, you'll see that he has an accounts receivable of $520. Okay. $520. All right. And we determined, so I'll put a little BB beside that. BB. All right. And then we've determined that he's not going to pay it, and we're going to write it off. Okay, so we're going to, you see it here on the screen, right? You see it right there. It says it's a credit to accounts receivable Kent for $520. So if that's our entry number one. Here, look at us now. So we got our beginning balance over here. Debit balance where it should be. He's not going to pay it. We got to get rid of it. There's the credit to remove it. So currently there's zero in account in from Kent. We just wrote it off. Now remember, this is an expense. which will show up on the income statement. It's going to end up lowering our income, which is bad, but it also lowers our taxable income, which is good. So even though we're writing off $520, we're actually not losing $520, and it'd be determined by, you could figure it out if you deal with your tax rate. Okay, if our tax rate's 20%, then we're losing 20% of, 80% of 520, not the entire amount. Okay, and this is the next part of it. Okay, so if Kent, maybe Kent went out and bought a big scratch card somewhere and won, 10 grand on a scratch card, or he just decided he wouldn't be a deadbeat and he wanted to pay his debt. Okay, so come later, Kent's like, hey guy, I'm sorry I didn't pay you. I have the money now. I'm going to pay you that money. Well, if that does occur, we have to actually go through a two-step process. We got to reinstate the bad debt, and then we can collect it. And that's what you see here. I'm just going to show the account for Mr. Kent. So the first thing, the top one there, you see a debit. Okay, a debit of 520. That'd be our second account. Okay, so it's a reversal, right? So we reverse that first account. So we can't erase. So but we can put that money back in. So here's our beginning balance. Here's where we zeroed it out. Now we put it back in there, and now we can collect it. When we collect it, can I write upside down? I think I did it backwards. That's right. Let me turn the board around. Oh god, that was backwards. All right. So our last one though is when we collect the cash. It's supposed to be a 3. It's not very good, but let me erase it. My high-tech paper towel for an eraser. All right. So this was back when we made the original sale. This was the write-off. This was the reinstatement, and this is the collection. Ultimately, we still have a 0 from Mr. Kent, but now we actually collected it. So we said this is the initial sale, this is the write-off, this is the reinstatement, and that would be the correct write-off because we actually collected it. I know it's kind of confusing, but it's just a matter of following the ins and outs of this receivable account for Mr. Kent. Okay? Got it? Good. Now, allowance method. Okay, now this is where it gets trickier. This is what you want, right? You're at home, I'm at my home, and I want to show you somewhat complicated accounting principles through the internet. All right, so the allowance method is probably a little more common. It's a little bit better because it's an estimate. It's kind of it actually kind of smooths out the income a little bit. And we're going to do an estimated loss whenever items are sold. Okay. So, and there's, again, within this method here, there's more than one way to do it. Okay, which makes it even better. Let me write some T's on this board real quick and see if I can explain this. All right. What's our example here? Oh, okay, we're almost done. So I'll just use a real example. How about that? Let's see. So we're gonna need cash. This is gonna be a full board. I apologize. We got AR. Allowance. Ooh, it's a lot of writing. Let's see. Sales. Down here. Bad. Debt. Expense. Alright. How am I going to do this? Alright. I might not need cash, but that's okay. So I got all these T's, all right? Probably don't need cash. Not for this. We don't want to make it too hard. So let's do a sale. And the method that we're going to use is percent of sales method. Okay, we'll use this example here. Okay, percentage of sales. All right. So we're going to sell $400,000 worth of probably music stuff, right? Music land's the name of it. But okay, so we're going to sell $400,000 worth of sales, credit sales, and the percentage of sales method says that 0.6% are going to be uncollectible. Okay, we're going to be uncollectible. All right. So if I were to record this, let's record the sales first. We'll write the $400,000 worth of sales for number one, and the $400,000 worth of accounts receivable. Okay, so when the sales were recorded, this would be the first entry. There we go. Sorry. You see the debit to accounts receivable because it's credit sales, and the credit to sales. Now, at the same time, we'll make a second entry to record the amount that we estimate we will not collect. Okay, and that's what you see the entries actually on the screen there. Okay, so we'll multiply $400,000 times 0.006, which is 0.6%, and that's going to leave us with a $24 amount. So we will subtract, or we will do a bad debt expense debit, and then use this new account called the allowance. Okay, allowance for doubtful account. So you see the twos there now. Okay. Okay, so there you see you have bad debt expense. Now we don't know of any actual bad debts at the moment. We expect to collect $400,000, but based off of prior history, about 0.6% will not be collected. So we're going to go ahead and expense it right now. This is an estimate. We estimate we're not going to collect all of it. We're going to collect, 99.4% of it. So we're going to go ahead and expense this allowance right now. Now, what does this mean? How do I present this, okay? So essentially what we're going to do, I'm going to erase cash because I'm not going to use it. So if we were going to, this allowance account is kind of similar to accounts to accumulate depreciation. It's kind of similar to sales discounts and sales allowances, where it's going to reduce an amount. Okay, it's a contra asset, and it's going to offset accounts receivable, as opposed to, accumulated depreciation is a contra asset that offsets your equipment accounts. Okay, your fixed asset accounts. So if I were to say, well, what's my value of my accounts receivable after these two entries? Well, you would have AR. So you got AR is $400,000, and we're going to subtract out that allowance, okay, which is what, $2,400. So I'm going to put N, I'm getting fancy here, NRV, net realizable value of my accounts receivable will be $400,000 minus $2,400. So we're talking $397 and let's try again. $397,600. Okay. So here, let's see if I can separate this out a little bit. Excuse me. You've got accounts receivable at $400,000. Okay, this is like subtraction, right? Because it's a negative to the positive of accounts receivable. Okay, because we've already written this off. Okay, so you've got your accounts receivable debit. You've got your minus your allowance. So my net realizable value of accounts receivable will be $397,600. All right. Complicated stuff. Okay. So, on top of that, there's another method too, which is called the percentage of accounts receivable. That's even different. Okay. Ultimately, it's the same thing, but the percentage of accounts receivable method is slightly different, and let's cover that. I want to try to cover that when we do the quick study, which I'm going to save until Wednesday. Okay. I think if we so this is what I need you to do. Okay. I'm going to give you a question as well for the discussion board. The first thing what you should really try to do, because this is a tougher chapter than we've had in the past. And I know you love doing those smart books, but if you can, the best thing you can do between now and Wednesday would be to suffer through the smart book as much as you can. Now, some of it might be like, I just don't get it. Okay. And if that's the case, then just keep, just do most of it. Don't submit it, and then you can finish it, after Wednesday. But I would recommend spending time between now and Wednesday at lunchtime to try to get that smart book done. It'll hopefully make the quick study much more... What's the word I'm looking for? I don't know. It'll make a whole lot more sense. Let's leave it at that, okay? So here is your question for the discussion board, okay? And this might take actually a little bit of actual work as opposed to just thinking of a movie. Now we'll have our fun question will be on Wednesday. It'll be a short question, like maybe something like favorite something else. But your tough question, if you will call it that, your question for Wednesday or for the week 1 question 1 is to maybe about a paragraph, try to describe the difference between the direct method and the indirect method of dealing with write-offs of accounts receivable. Okay, it's in your book. I'm sure there's resources on YouTube, on Google. So do a little bit of work to try to figure out the difference. Okay, the majority of it is that the allowance is an estimate, and direct write-off there is no estimation. But come up with something better than that, and just write it out for me in question number 1. Question 1, week 1. I'm sorry, try it again. Week 3, question 1. Okay. List out some differences, if there are some, between the direct write-off method and the indirect write-off method for accounts receivable, guys. All right. So try to do a smart book, answer the question, and the quick study will be done in full Wednesday around noon. So roughly noonish on Wednesday. God bless. We will see you then. Enjoy your 2 days. Get some work done. Get that Chapter 6 stuff done, guys. It's got to get in. We need those points. You need those points. I don't need them. You need them. Okay? Take care.